The internet is a very loud place when it comes to money. Open any social media app and you are immediately bombarded with conflicting, high-anxiety advice. One person tells you to leverage yourself into real estate. Another screams that the stock market is crashing and you should buy gold. A 20-year-old in a rented luxury car tells you to day trade crypto. Most people suffer from this financial noise. They end up paralyzed by indecision, or worse, they randomly invest $50 here and $100 there, hoping something magically works out. They build their financial house by throwing bricks into the air and hoping they land in the shape of a mansion. But wealth creation is not random. Money follows strict rules of logic, mathematics, and probability. Today, we are going to completely mute the noise. We are not going to talk about hot stock picks, chart reading, or get-rich-quick predictions. Instead, we are going to build the definitive, mathematically optimized structure for your capital. This is not just a casual list. This is the sequential, step-by-step hierarchy of exactly where your next dollar should go for maximum mathematical impact. We call it the financial waterfall. Welcome to Bruce Invests, where we explore the calm, practical, and often invisible realities of money that most people are too busy consuming to notice. Let us get started. We must begin at the absolute foundation, step 0, the budget and the cash flow surplus. Before you can invest a single dime, you must spend less than you earn. This is the unbending law of physics in the financial universe. It does not matter if you make $50,000 a year or $500,000 a year. If your outgoing expenses match or exceed your incoming revenue, you are flat broke. You cannot build wealth while simultaneously creating new debt. You must track your expenses, identify the invisible waste, and create a positive monthly cash flow. You need a disciplined budget that forcefully creates a surplus of capital at the end of every month. This surplus is your financial ammunition. If your surplus is 0, your investing journey simply cannot begin. You must fix the leak in your boat before you try to sail across the ocean. Assuming you have organized your life and successfully generated a surplus, we move to step 1, the micro-emergency fund. Many eager beginners want to take their very first surplus dollar and immediately throw it into the stock market. This is a mathematical mistake. Life is predictable only in its unpredictability. Car tires blow out, water heaters explode, bodies get sick. Your first investment is not in equities, it is in liquidity. You need to immediately establish a cash reserve of $1,000 to $2,000, or roughly 1 month of basic survival expenses, sitting quietly in a standard, accessible bank account. This money is not an investment designed to make you rich. It is your financial armor. Its sole purpose is to stand directly between you and a high-interest credit card when a minor emergency strikes. It prevents you from digging a brand-new hole of debt every time life hits a speed bump. Now that you have a basic shield, we confront the greatest enemy of wealth creation. Step 2. Conquering high-interest debt. This is where the math becomes absolutely ruthless. High-interest debt, particularly credit card balances, payday loans, or high-rate personal loans, is a mathematical guarantee that you will remain poor. Credit cards often carry staggering interest rates of 20 to 25%. There is no reliable legal investment strategy on earth that consistently yields 25% returns year after year. Therefore, mathematically speaking, paying off a credit card balance with a 20% interest rate is exactly identical to receiving a guaranteed, risk-free 20% return on your money. Ignoring this toxic debt so you can invest in a stock market index fund that yields a historic average of 8% is financially irrational. You are walking backward on a treadmill. Treat high-interest debt like your hair is on fire. Wipe the slate clean, destroy it entirely before moving any further. Once the bad debt is entirely eliminated, you have freed up even more monthly cash flow. Now, we look at the absolute lowest hanging fruit in the entire financial world. Step 3, the employer match. If you have a 401k or a similar employer-sponsored retirement plan, this is your first true investing priority. Why? Because an employer match is the only place in the world where you can get free money. If your employer offers to match your retirement contributions up to 5% of your salary and you do not take it, you are literally refusing an instant guaranteed 100% return on your capital. It is a mathematical absurdity to leave this money on the table. Contribute exactly enough to capture every single penny of that match. Do not contribute $1 more at this specific stage. Just capture the free money and move to the next step. With the free money secured, it's time to build a massive, impenetrable wall around your life. Step 4. The full emergency fund. The micro fund in Step 1 was designed to protect you from life's small annoyances. This fund, Step 4, is designed to protect you from life's major catastrophes, namely sudden job loss, severe medical issues, or a deep economic recession. You need to expand your savings until you have a cash cushion of 3 to 6 months of basic living expenses. This money should be placed in a high-yield savings account, earning a modest interest rate to fight inflation, but remaining completely liquid and safe from market volatility. This cash does not generate massive wealth. It generates something far more valuable: freedom and total peace of mind. It gives you the power to walk away from a toxic employer without panicking. It ensures that if the stock market crashes by 30%, you don't have to sell your long-term investments at a severe loss just to pay your rent. Now your foundation is built like solid concrete. You have no bad debt, you are capturing free money, and you are fully protected from economic emergencies. Finally, we enter the realm of aggressive wealth building. Step 5. Tax-advantaged accounts. Taxes are the silent, invisible destroyer of compound interest. A massive portion of your long-term wealth can be eaten by the government if you are not strategic about where you place your capital. Before you open a regular brokerage account, you must maximize your tax-sheltered vehicles. This means fully funding a health savings account, or HSA if you're eligible, which offers a rare triple tax advantage. It means maximizing a Roth IRA, where your money is taxed today but grows completely tax-free forever, meaning the millions you withdraw in retirement are yours to keep. It means going back to that 401k and contributing far beyond the employer match, effectively reducing your taxable income today. These accounts are entirely legal tax shelters provided by the government to incentivize saving. Use them, max them out. They are the absolute strongest engines for compounding wealth over decades. If, and only if, you have conquered every previous step on this list and you still have surplus cash left over at the end of the month, you have successfully arrived at the final destination. Step 6. Taxable index funds and real estate. This is where you open a standard brokerage account and buy broad market, low-cost index funds like the S&P 500. There are no contribution limits here. You can invest as much as you want, and you can withdraw the money whenever you want without age-related penalties. This is also the stage where you might save for a heavy down payment on a physical investment property to generate rental income. Because you followed the correct sequence, this money is truly surplus. It can ride the wild roller coaster of the stock market or the housing market for decades without causing you a single night of lost sleep. This structure, this hierarchy, is the definitive algorithm for optimal financial decision-making.
It ensures you never try to build an investment portfolio while quietly bleeding out from toxic debt. It ensures you never miss out on free employer capital, and it guarantees you systematically leverage every possible tax advantage before relying on standard taxable accounts. Stop throwing your money at random ideas based on emotion and internet noise. Follow the waterfall. Follow the math. If you found this perspective valuable, consider subscribing to Bruce Invests. We'll keep exploring the calm, rational realities of money. Thank you for your time.